Hello, everyone, and welcome to this Boutiques Connect with me, Mosidi Modise, where I have the pleasure of engaging with Gavin Wood, who is the Chief Investment Officer at Camissa Asset Management. You are in for a very great discussion today, as Gavin and I are going to be delving into this key topical issue around passive versus active management. What is the strategic rationale where it might make sense to have passives within your client portfolio? So, Gavin is here joining us as an active manager to unpack the topic. A very warm welcome back here on Asset TV, Gavin.
Thank you very much.
So, Gavin, there's a lot of noise in the market around passive being the future. Costs are justifiable. It provides a level of consistency within portfolios. But you've argued that if investors want real long term performance, perhaps they need to actually think very carefully around what they're actually buying. So, before we get to the nuts and bolts of the case for active, let's define a few things. So, when you talk about true active management, what does it mean in practice?
Yes, I think that it's a very important concept to get one's mind around if you are putting portfolios together where you're blending different managers and you're trying to think about what styles makes most sense, most cost adjusted and risk adjusted sense long into the future, given your objective. So if we're talking about, in particular, let's say South African equity management or South African equity funds, and that's a very large portion of most balanced funds. So let's think about where most investors in South Africa are invested. It's got a large portion of South African equities. Now, I think that passive investing and passive funds have a really good place in portfolios and in the mix. And in particular, their attributes are very well known: lower price and complete consistency with the benchmark. Now, what I want to talk about today is when one's considering putting together the active part of a blend of portfolios, what one should take in mind or bear in mind when one's considering that. And so, in particular, what I mean by active management is a manager or a fund where the positions in the fund are really very different from a passive fund or from the index or from the benchmark. So I think what one first of all wants to choose, if you're putting together a portfolio of active managers, you want to find an active manager who first and foremost takes large positions away from the benchmark. So it's truly active. I think there's a lot of criticism, and justifiable criticism, for a lot of managers, and globally there's a lot of them, who are closet index trackers and charging a high active fee. Now that is, I think, completely justifiable in being criticized, heavily criticized, and people moving away from that proposition, where the proposition is you get active management marketing and a feel for being in an active management position, but you're actually getting a fund that's quite close to a passive fund at high fees. Now, that I think is a very justifiable position to move away from. So what you want first and foremost is a manager or a fund which takes large positions relative to a benchmark. Now, the key metric I would suggest people look at when analyzing whether you're getting that or not is to look at all the active positions that a manager takes relative to the benchmark, and you can quantify that. So and there's a measure of summing all the active positions up. If you sum all of those up, there's a measure called active share. So the degree to which you are an active manager, the more you're an active manager, the higher your active share. Now, to put it very simply, active share is the sum of all the different positions relative to benchmark or relative to passive. So if you just very simply think, you've got a passive fund and you take your 5 best ideas and you take 1% more in each of those ideas, okay? So that's 5% active positions, okay? Now you've got to fund those by an underweight position in your 5 least favorite ideas. So that would be another 5% of active positions, and there'd be negative positions that are active. So you add those all up. So you've got 5 positives, 5 underweights, and you put them together, you've got 10% active share. So if you think about just calibrating your mind, if you've got 5 overweights 5, underweights just 1% relative to benchmark, which is quite a closet index tracking fund, quite going to deliver outcomes very similar to benchmark. That's a 10% active share. Now, extending that to get to, let's say, a 20% active share, you do your 10 favorite ideas, 1% over the benchmark weight and 1% under the benchmark weight for your 10 least favorite ideas, you're going to get a 20% active share. Now, still, that is reasonably close to passive. You've got pretty much a passive portfolio and 20% active share. Now, you can extend that and go and quantify what the funds that you're invested in, if you look at the holdings and compare them to benchmark. So I think that's a very, very important measure to think about how active a manager is. So that's the first sort of concept I would think about when choosing an active manager. We can get back to when we look at that and we look at the largest funds, where that puts you. The second part of what you want from an active manager is if they're taking those positions relative to passive or benchmark, you want them to be more right than wrong. So you want those favorite ideas to actually outperform, and you want the least favorite ideas to underperform over time to get you outperformance. Now, so that's the second component of what you need to think about when choosing active managers is skill. So skill is how, in the longer term, how right you are relative to how wrong you are. If you're more right than wrong, you have skill. So you want an active manager who takes high active positions, high active share. You want one who is skilled. And the other component that comes with that is, in general, it's almost impossible to find a skilled manager which charges low fees. So if you want outperformance of a benchmark over time, meaningful outperformance of a benchmark, you need to take a high active share manager, truly active manager. You want them to have skill, and if they have skill, they're never going to come at you at a low price. So then the other component that people need to be very happy with in choosing an active manager is, by definition, if you take these big positions relative to the market, your skill isn't in predicting every movement every single moment of every day. So at times, your big positions relative to benchmarks will underperform. So what I always tell our clients is that what you really need, if you want true long-term outperformance of benchmarks, so real outperformance of passive, you need to be comfortable with the manager needs to take high active share, big, truly active. B, have skill, and we can explore how one potentially identifies that and some pitfalls in identifying that. And 3, reasonably high fees, not low fees, and at times underperformance of the benchmark. That's the cocktail you've got to sign up for if you want outperformance of benchmarks in the long term. If you don't want some of those things, if you want low fees, then you should go passive. If you want inconsistency with the benchmark, you should go passive. And in other words, and if you never want underperformance of the benchmark, you should go passive. So I think one really needs to know what's on the tin when you get true active management, and what you need to bear in mind along the way towards achieving true outperformance of passive.
Great stuff. Now, Gavin, you've articulated very well what active share is, and then also what's kind of like the key ingredients and where people should do a blend of both. But if we take a deeper look into the South African equity market, it's quite concentrated. And as managers get bigger, you touched on that, but I'd like to kind of further flesh it out. As managers get bigger, how does this affect their ability to maintain active share, and what should investors be asking large active managers about this?
Yeah, so I think that one of the things that's really important is to understand how concentrated our equity market is. Now, our top 30%, our top 30 stocks, I've got it here in front of me. Our top 30 stocks in our market account for 80% of our market cap. Top 30. Our top 50 shares account for 91% of our market. So we have a very concentrated market, and it drops from the 20th or 30th stock quite steeply down towards the 50th stock. So we've got a very concentrated market. Now, by just mathematically, as let's say a manager has high active share and skill, if they get bigger and bigger and they have client inflows and they get very large, their choice of stocks to have a position in, have a meaningful position relative to the benchmark, gets smaller and smaller and smaller. So to maintain a high active share, you are going to have fewer and fewer choices, which either your skill needs to be exceptional to have outperformance with very large active share positions in a small number of stocks, or you're going to start delivering mediocre returns. So I think that's something to watch out for, on the active share side and being able to maintain a high active share, and then B, on the risk side of how concentrated you then become and how you're lacking diversification because our market's so concentrated, and then C, whether you're able to have skill enough in a small number of options to be able to deliver on what you were able to deliver when you were much smaller.
Now, many investors in South Africa try to kind of manage this risk by blending 3 or 4 active managers, quite commonly maybe in like multi-manager solutions, for example. And from your analysis of the largest, say, SA equity funds, what typically happens to active share and fees when they do that, Gavin?
Yeah, so what we on a monthly basis track, and we just go and look at the largest equity funds in the South African market, and you can go and look at those, and by definition those are the most popular funds because they are the ones that are largest. That's where most advisors have their clients. So if one looks at that, you can find, and remember that example I gave right at the beginning of 10 overweights and 10 underweights of 1% each, which sounds quite passive, gets you 20% active share. Now bearing that in mind, the funds, the top 4 funds by size in South Africa, range of active shares, they range between 32% today and 52%. Now, 52% is reasonably high and 32% is reasonably low. So those are, and I explained how 20% is reasonably passive. It's just 10 overweights and 10 underweights of 1%. Now, 52 to 32 is quite a range, and 52 is reasonably high, 32 is reasonably low. Now, I think, and when I speak to advisors, when I speak to clients, what a lot of people do is blend those large funds. And almost by definition, it has to be the case because that's where those are the largest funds. That's where the most popular funds are. So if you blend the largest equity funds, and by definition, if you blend the largest balanced funds, they're often the same managers, usually the same managers. Our analysis shows that if you blend those with 52% down to 32% active share, if you blend them in equally, quarter, those 4 managers, you engineer yourself a portfolio that's 25% active share. So you basically reduce the idiosyncratic positions that these, let's say they're skilled managers, put in their own portfolios. You're blending them away, and you're engineering for yourself a 25% active share fund by blending those 4 managers, but you retain that high fee. So you're getting active management fees at benchmark hugging or semi-passive outcomes. Now that doesn't make sense. So just in contrast, and to just tell you where we sit, and we really position ourselves as a skilled manager, and we have the track record, the long-term 20-year track record to show that we're skilled, and B, high active share manager. So our active share over the last 10 years plus, and the one we've just put in graphs is the last 10 years, has averaged 70%. Now, that is true active management. Is a 70% active share with a manager that delivers consistently over the long term outperformance. That's what I was talking about, high active share and skill. So if you engineer the top 4 funds, most clients out there are getting a 25% active share. With our fund or a similar type of manager to us, you could get 70% active share. That's true active management, and that's what you would want to blend with a passive solution and get lower fees.
And just on that, Gavin, what are the better ways to kind of combine this passive and active so that clients don't end up with a semi-passive portfolio at active fees? Like, what's been your strategic approach?
Yeah, so I personally would advocate having fewer active managers. In other words, not having four, perhaps having two or three, and then having those managers and looking into those managers' funds and seeing that they are truly doing something different, and doing something very different from the benchmark. In other words, high active share, and preferably if those managers are doing something slightly different to each other, and they're finding their alpha from different sources. So I would reduce the number of funds you blend and then blend that with passive if you want to lower the fees. I mean, you could just blend active, a small number of active managers, or you could blend with passive. Another obstacle I often find is that advisors tell me that they can't not have some of the large managers. Now, that might also be fine because clients want those managers. You may then also, rather than passive or together with passive, have one large manager and then one or two medium-sized managers with high active share, because I just don't think the large managers are able to deliver high active share. And so I think those are the sorts of things one would want to do to get the right outcomes, because what you're wanting is outperformance and you want therefore high active share and skill. So I think the other thing we could explore is potentially how one would identify what skill is, and some of the pitfalls to that.
And what is that like? We yeah, in your case, yeah, what is your view on that?
So I think that what one needs to look at is a longer term track record. Now, you want to have a long-term track record of outperformance. So if you can't outperform in the long term, then clearly passive is the right solution relative to someone who can't outperform in the long term, because it's lower priced and you're going to get that benchmark, which can't be outperformed. But there are managers in the South African context who can outperform. We are one of them. We have been one of them. And when one looks at skill and tries to assess skill, I think you want to be looking at a 10-year plus track record of outperformance, of being better than the benchmark. Now, that's one thing. The other thing, and I think some of the pitfalls that people fall into when looking at that, is clearly managers who are successful, who outperform, they attract lots of business and they get lots of clients wanting to join them. Now, the problem with that is they could get so big that they lose their competitive edge or the ability to have that active share or to do what they did when they were much smaller when they're much larger. So I think clients need to be cognizant of how that size of the manager's equity assets have moved through time and how relevant the track record is and that assessment of skill is on the current larger asset base. So that's one thing I think one needs to be cognizant of. You can't do the same things when you are hundreds of billions of rands in funds relative to when you were 50 or 60, 70 billion rand. The other thing that I think one needs to do is, when looking at long-term track record to assess skill, one needs to look at the continuity of the personnel that have been managing the funds. So if there has been lots of turnover of the people and the brand remains the same and the fund is called the same thing and it's delivered reasonable returns, I would suggest I put some question marks around whether that is truly a skilled manager, and the good early performance is not so relevant to the later personnel. So I think personnel continuity through time is pretty important. So I think a lot of the trap that people fall into is buying a good brand with a good long-term track record, which has attracted a lot of assets, which is much bigger today, which has a completely different investment team. They're the same brand and they're claiming the same track record, and they're a different investment team. So that for me raise a question mark. And so regarding whether that skill is truly relevant, it may be, and they may have been able to pass on that skill and have continuity. That may be the case. I would just ask that question. So that's the one thing. And then there's that size question I talked about.
Yeah, those are very good and relevant considerations for investors, Gavin. And like my final question, just to wrap it up, if someone is currently, say, reviewing a client or their very own portfolio today in this active versus passive debate, what are the one or two questions they should ask their equity manager to check if they're really getting for value for money?
Yeah, so look, I think that the key question is, what inefficiencies the manager's exploiting, where their skill what their skill derives from, their investment approach. What is it about markets that enables them, and what they do in their approach, what enables them to outperform? And someone needs to really clearly articulate something unique and really exploitable. And that's the first thing. And then one needs to go and look at the evidence, and this is sometimes hard to do, and sometimes there are intermediaries that will do that for a client, of whether there's consistency between what the manager said and what they delivered. I think that another subtlety in that is that they haven't changed the answer to that question through time, because then it makes their track record a lot less relevant. If they are saying they now have a different approach to what they had 5 years ago, then they can't really be claiming last 5 years ago's track record. So I think that's a key question for a manager to have to answer and to have to justify, and then the evidence has to back it up. And then I think simple questions around what their active share is, and that's a simple quantitative tool or quantitative measure that one can look at and ask for when assessing a manager. And if that is very low, if active share is very low, then I think that they're not delivering on true active management. So yeah, I think it's all around this active share, being truly active, having skill, because you don't want an active manager who takes lots of big positions and then is more wrong than right. That you don't want. Rather have passive there. And the final point I'd just make is I would be, and obviously this is self-serving, but I would be less concerned about the active management fee, because one of the inconsistency that people are often trying to pursue is you're wanting that skill and low fee. And I think that sort of thing doesn't exist. So if a manager is truly skilled, they're not going to have low fees. So I think that's what would be another indicator to an extent of whether a manager is truly skilled, is if they really have low fees, they're not necessarily going to be truly skilled, because they're not going to be giving it away. It's a rare capability to have true investment skill. Truly skilled managers don't have very low fees.
Fantastic. Well, thank you so much, Gavin, for joining us. You hold such a breadth and depth of knowledge on the topic, and it's also been really great to get a very balanced view from you as an active manager around this continually kind of hot topic in the South African investment management environment. So thank you so much for joining us once again.
Thanks very much, Mosidi.